Hello ladies and gentlemen, and welcome to this short presentation on the economic measures developed by the Union to tackle the COVID-19 crisis. Over the past weeks we've seen many measures being announced, economic measures, and we thought maybe it was useful to provide an overview of these measures and to show how these measures are expected to fit together. Besides this overview video, we've also made some more specific in-depth videos on different components of the economic response program. Please check them out and we hope you enjoy our presentations. The proposed measures really came in two waves. So we had a first wave by mid-March 2020 and then a second big package was announced by the beginning of April by the European Commission. Key actor in all of this is of course the Commission, as they proposed the measures and presented them to the legislator, which is primarily the Council, because we're dealing mostly with emergency measures, so the Parliament is less involved in formal terms, in procedural terms. But besides the Commission, also other institutions have stepped in and come forward with their own proposals and with their own measures, in particular the European Central Bank, the European Investment Bank, and eventually the European Stability Mechanism. But let's first start with the Commission. First, the Commission has set in place a temporary framework for the state aid rules, effectively loosening and easing these state aid rules until the end of 2020. The goal being to ensure that there is sufficient liquidity, there is sufficient credit available to businesses in the market so that they can overcome the temporary effects of this corona crisis. So government grants, tax breaks, all kinds of loan guarantees are now more broadly possible as long as the member states respect the time limitations, they respect the clear ceilings that are set out in the temporary framework, and that their measures clearly target corona-related effects. A second set of similar measures or measures of the Commission is the fact that the Commission has invoked the General Escape Clause for the Stability and Growth Pact, which basically states that member states may be temporarily allowed to depart from their adjustment path towards medium-term budgetary objectives, which basically means that member states can now be allowed to run larger deficits for one-off and clearly corona-related measures. So the Commission is both easing the state aid rules as well as the fiscal rules in order to ensure that they have enough room to reduce their tax revenues because they give tax breaks, or increase their expenditure and hence thus run larger annual budget deficits and overall debts. A third initiative that the Commission has set in place is the Corona Respond Investments Initiative. That is an initiative whereby existing resources from the structural funds, from the Globalization Adjustment Fund and from the European Union Solidarity Fund are redirected towards COVID-19 related expenditures, so healthcare systems, healthcare workers. We also have a specific and separate video on this initiative created and made for you. The Commission also activated the emergency support instrument. This was an instrument that was created after the refugee crisis to provide humanitarian assistance within the EU, and something like 2.7 billion euros have been redirected towards that emergency support initiative. And that is there, for instance, to secure vital equipment and supplies ranging from ventilators to protective personal gear, eventually also support for medical assistance in refugee camps, or testing efforts, development of treatment, all part of that emergency support instrument. Resources are made available. Through this instrument, the Commission can also do the procurement on behalf of the member states. Another initiative, and that's a new one, a brand new one, is the support to mitigate unemployment risks in an emergency. That is financial assistance for member states who have set up temporary unemployment systems or short-time worker schemes. They can get financial support from the Union. It's a new system, and we've also made a separate video on that specific topic. Then one other package, broad package, is aid for the most deprived, so clothing, food for the poorer strata of society. And then also support packages, aid packages for farmers and for the fishery, aquaculture sector, farmers struggling, for example, because of the absence of seasonal workers, and then also drops or fluctuation in demand, for example, for the fishery sector, who have seen the entire hospitality sector, the restaurants, the canteens, etc., stopping and hence no longer purchasing the fishery products. So specific aid support programs for those sectors. So with this plethora of measures, and in the space of about a month, the Commission has set up quite a comprehensive package of economic measures to support the member states and businesses in the member states. Besides the initiatives of the European Commission, other institutions have also stepped in, namely, for instance, the European Central Bank. It has set in place its Pandemic Emergency Purchase Program, the PEPP, and is planning to infuse 750 billion euros of liquidity in the market through the purchase of government, but also of private corporate bonds. This asset purchase program is ultimately thus there to ensure stability in the debt market and also to ensure sufficient liquidity in the economy. By the end of 2020, the ECB will thus have bought probably up to 1 trillion euros worth of bonds from the market. So that is quite a significant intervention. Next to the ECB, we have the European Investment Bank, which has created a guarantee fund, 25 billion coming from the member states, from EU budgets and some of its own resources. And these 25 billion euros worth of guarantees will help financial intermediaries, that is banks, to free up capital to SMEs and mid-caps. The EIB estimates that through leveraging effects, you will thus have about 200 billion euros of credit lines, of loans, of guarantees being made available, in particular to SMEs and mid-caps. Next to the EIB, we also have the European Stability Mechanism. This is for Eurozone states. It has set up a pandemic crisis support for Eurozone members, and they can benefit from cheap loans for up to 2% of their GDP to finance healthcare costs, development of cures, but also prevention costs. So this is about 240 billion euros worth of borrowing that member states, Eurozone member states, can tap into. These loans can be had without the usual eligibility or conditionality requirements, the reform programs that are usually imposed, then also not in this case, because the loans are handed out through the so-called enhanced conditions credit line. The main condition is that the financial assistance goes to cover health costs. So altogether, we have the ECB infusing money into the economy. We have the EIB, the investment bank, seeking to channel those resources to SMEs. And then we have the ESM, the stability mechanism, offering cheap debt financing to governments. So combined with all the national initiatives, which are also taking place, the EU efforts can be deemed to be quite significant and probably sufficient to deal with the immediate economic consequences. For the post-corona recovery, we will probably need to go much beyond these temporary measures. Most of these measures are applicable until the end of 2020. And that will thus bring a focus on things like a new Marshall Plan or a recovery plan with or without corona bonds, and also focus on a 1 trillion euro multi-annual financial framework, maybe a larger one. So these will be the topics to look out for in the following weeks and months, the recovery plan and the multi-annual financial framework.